Hello. Today, we're diving into something that could genuinely impact your bottom line. Tax amortization benefits in the UK.
hmm
And we're able to explore this complex area thanks to my tax account. They've arranged this discussion, providing the source material, HMRC guidance examples.
That's right. We've been looking through how UK companies can get tax relief, basically, on the value of certain intangible assets they hold.
Intangible assets.
Yeah, things you can't touch. Think of this relief as, well, a way to cut your taxable profit. It directly saves cash on corporation tax.
Sounds good.
It is. It's a powerful tool, definitely. But the rules, well, they're laid out in places like HMRC's Corporate Intangibles Manual, and you really need to navigate them carefully.
Okay, let's unpack that then. What exactly are these tax amortization benefits? TBs, you might call them.
At its heart, it's a tax deduction. You claim it when your business accounts show the value of certain intangible assets decreasing over their lifespan.
Okay, so it's linked to the accounting treatment, this decrease.
Right.
It's called amortization, right?
Exactly. It's very much like depreciation for physical assets, but for those non-physical ones.
So, like spreading the cost over the asset's useful life.
Precisely. And the sorts of assets that often qualify, things like intellectual property, patents, copyrights, trademarks, also software licenses, even sometimes certain customer lists, if they were acquired in a particular way.
Right.
The whole point is simple. Reduce your taxable income, lower your corporation tax bill, save cash.
It sounds like a bit of a no-brainer way to save money. But I'm sensing there might be a catch. Tax rules aren't usually that straightforward.
Yes. And this is where it gets particularly important. It's a critical point from the sources. The goodwill trap.
Goodwill trap.
Basically, goodwill, the extra value paid for a business, for its reputation, customer base, that sort of thing, if it was acquired after July 2015.
Yeah.
It's generally not eligible for this tax relief.
Wow. Okay. That date again, 8th July 2015. That's a huge restriction, surely. Loads of acquisitions involved goodwill.
It is huge. And it's a really common pitfall. Businesses sometimes miss this. HMRC deliberately tightened the rules, partly to stop certain tax avoidance schemes using goodwill.
I see.
So the bottom line is you just can't rely on amortizing goodwill bought after that date to cut your tax bill using these specific rules.
Got it. No tax relief on recent goodwill.
Okay.
Okay. So let's go back to the assets that do qualify the patents, the software you mentioned. How does the actual tax deduction work for those in the UK?
Well, HMRC gives you effectively two main options for calculating the deduction for tax purposes.
Two ways to do it. Okay, tell me more.
Option one, you can simply follow the amortization charge you're already putting through your company accounts.
Right.
That's assuming, of course, your accounts follow generally accepted accounting principles, GAAP, which most standard UK business accounts do.
Okay, so if my account's following the rules, say I'm writing off like £10,000 this year for a patent.
Then yes, assuming it qualifies and your accounts are GAAP compliant, you can deduct that £10,000 from your taxable profit.
Makes sense. And option two.
Option two, you could choose a fixed rate deduction instead. It's 4% of the assets cost each year.
A flat 4%.
Yes, 4%. And that's regardless of how you actually treat it in your account. So it doesn't matter what your accounting amortization is. You can just take the 4%.
Why would you choose that?
Well, it can be useful if, say, the asset has a very long life, or maybe an indefinite one where accounting amortization might be tricky, or, frankly, some might just prefer the simplicity of a fixed, predictable number each year.
Okay. Can you give a quick example, maybe based on the source material?
Sure. Let's take that £100,000 patent example. Eligible asset costs £100 K.
Right.
If your accounts amortize it over, say, 10 years using GAAP, that's £10,000 amortization per year. So £10,000 tax deduction under option one.
Okay.
But if you chose option two, the fixed rate,
Yeah.
that's 4% of £100,000, which is £4,000 per year.
I see. 10K deduction versus 4K deduction in that case.
Exactly. And what does that mean in actual cash saved?
Yeah, that's the key question.
Well, every pound you deduct reduces your taxable profit. Thinking about the corporation tax rates for, say, 2025-26, you're typically saving either 19p or 25p for every pound deducted, depending on your company's profit level.
Right. The main rate is 25%, but smaller profits are 19%.
Precisely. So that £10,000 deduction, if your company is paying the 25% rate, that saves £2,500 in tax. Cold, hard cash.
£2,500 a year, just from that one asset, potentially.
Exactly. And Even the 4,000-pound deduction saves £1,000 at the 25% rate. At the 19% rate, you're still saving £1,800 or £760 respectively. It all adds up.
Okay, so this isn't just like an accounting entry. It directly translates into more cash staying in the business.
Absolutely. Every pound you don't pay in tax is a pound you can keep. That's cash flow. Money you can reinvest, maybe hire someone new, spend more on marketing, R&D, buy equipment.
Really frees up resources.
It does. This isn't just about ticking boxes for compliance. It's
Right.
about unlocking real financial potential in your business.
It sounds incredibly valuable, but I have to say, also quite complex. You mentioned the goodwill trap, these two different calculation methods. It feels like there are places you could easily slip up.
Oh, it is complex, no doubt about it. The rules are very detailed, spread across various HMRC manuals and guidance on gov.uk. And getting it wrong.
What happens then?
Well, claiming for assets that don't actually qualify, maybe using the wrong deduction method for your situation, or simply not having the right records to back it all up, that can lead to problems. HMRC inquiries, potentially penalties, interest charges, and of course you might just miss out on savings you were entitled to.
So how does a business owner who's already juggling a million things realistically navigate all this? How do you avoid the traps, but also make sure you're not leaving money on the table?
Yeah, that's the challenge. Given the complexity and, frankly, the potential value involved, this is absolutely one of those areas where getting expert help is, well, invaluable.
Right.
It's not just about avoiding mistakes. It's about proactively identifying all the opportunities you might have.
And I guess this brings us back around to my tax accountant, who, as we said, arranged this discussion based on the materials.
Precisely. A good tax accountant, someone specializing in this area, can really dig into your business. They can identify exactly which intangible assets you own might qualify for these benefits.
Okay.
They can help you figure out the best deduction method, JAP versus the 4% fixed rate based on your specific assets and your business's circumstances. Crucially, they ensure everything's documented correctly and fully compliant with HMRC's rules.
So peace of mind, but also potentially more savings.
Absolutely. It's about maximizing the relief you're entitled to. The source material actually included a case study, a business called Buttercrust Bakery. My tax cabinet apparently reviewed their situation, found some errors in how things were being treated, and by correctly applying these tab rules and some related reliefs, they managed to achieve an annual tax saving for the bakery of £15,250.
Wow, £15,000 a year just by getting the treatment of these intangible assets right.
That's the figure mentioned, yes. It really shows the kind of real-world impact we're talking about. Getting expert help isn't just a safety net against errors. It's often the key to unlocking the actual relief you're due.
It really transforms it from a complex compliance headache into a potential source of significant value.
That's exactly it. Turning complicated rules into tangible financial benefits for your business.
So maybe a final thought for everyone listening. Think about the value in your business, not just the machines or the building, but the ideas, the software you've developed or bought, the brand reputation, the customer relationships. Could there be untapped potential sitting right there in those intangible assets, potential that could be realized through, well, smarter tax planning around these benefits?
It's definitely worth considering. Understanding these benefits and making sure you claim correctly can give your business's cash flow a significant boost.
So, if navigating UK tax amortization benefits feels a bit daunting, or maybe if you just have a hunch your business has eligible assets you're not currently claiming relief on,
Don't ignore it.
reaching out to a professional seems like a very sensible step. We understand that Mr. Maz, the CEO of My Tax Accountant, actually offers a free initial consultation specifically to help businesses explore these kinds of opportunities.
Yeah, a consultation like that could be a great first step. Get an expert eye on your specific situation. See what the potential savings might look like.
You can find more details and arrange that consultation by visiting their website. It's www.mytaxaccountant.co.uk.
Definitely worth looking into.
Absolutely. Don't let the complexity stop you from accessing tax relief that your business might well be entitled to.